The 2025 housing market isn't just in crisis, it's experiencing the most severe collapse in buyer demand in over 3 decades. What's even more shocking, the real estate industry is desperately trying to hide a massive, historic demographic shift that's making the 2008 crash look like a mere preview of what's coming. Let me tell you a story about what's really happening in the American housing market right now. Just this week, the Wall Street Journal revealed something that sent shockwaves through the real estate industry. Home sales have plummeted to just 4.06 million units, matching the devastating levels we saw during the 2008 financial crisis. This represents a staggering 34% drop from the pandemic peak and 24% decline from the pre-pandemic levels. But what we're about to share with you makes 2008 look almost quaint by comparison. You see, back in 2008, we were dealing with a financial crisis that unfolded in a very specific way. It began with predatory lending practices that put millions of Americans into homes they couldn't afford. Lenders were offering something called ninja loans. No income, no job, no assets required. They were giving out adjustable rate mortgages with teaser rates as low as 1%, knowing these rates would reset to unaffordable levels in just a few years. When those adjustable rates began resettling in 2006 and 2007, we saw the first tremors of the crisis. Homeowners who had been paying $1,200 monthly suddenly saw their payments jump to $2,500 or more. The initial wave of foreclosures began in the subprime market, but as home prices started falling, it triggered a vicious cycle. Even homeowners with good credit found themselves underwater on their mortgages, owing more than their homes were worth. By late 2008, home prices had fallen 10% year over year, according to the National Association of Realtors. By 2009, that decline accelerated to 17.7% as a wave of foreclosures flooded the market with inventory. The crisis peaked when about 3 million homes received foreclosure notices in 2009 alone. The national homeownership rate fell from its peak of 69.2% in 2004 to 65% by 2013. That crisis was devastating, but it followed a predictable pattern that we'd seen before in financial markets: excessive leverage, speculation, and then a crash. We fixed it through a combination of financial regulations like the Dodd-Frank Act, monetary policy with near zero interest rates, and programs like HAMP, Home Affordable Modification Program, that helped millions avoid foreclosure. What we're facing today is something far more fundamental and, frankly, far more concerning. Instead of a financial crisis that we can fix with policy changes, we're seeing a structural transformation in who can afford to participate in the housing market at all. The American dream of homeownership is undergoing a transformation that nobody wants to talk about. Think about this. The median age of homebuyers has jumped to 56 years old. That's a full decade older than before the pandemic. An entire generation isn't just being delayed in buying homes, they're being completely priced out of the market. This shift isn't temporary, it represents a fundamental change in who can afford to participate in the housing market. Let's dig deeper into who's actually buying homes in 2025, because these numbers tell a fascinating story about wealth inequality in America. The market has become dominated by married couples, who make up 62% of all purchases. This is significant because it represents a concentration of household wealth. 2 incomes are increasingly necessary to afford a home in today's market. Single women have emerged as a surprisingly strong force, accounting for 20% of buyers, while single men lag behind at 8%. This gender disparity in home ownership reflects broader economic trends in education and income growth. Perhaps most telling is that unmarried couples, often young people trying to pool resources to afford a home, represent just 6% of buyers, a clear sign that even combining incomes isn't enough to overcome today's affordability barriers. Now, here's where things get really interesting. First-time homebuyers now make up just 24% of all purchases, down from 33% before the pandemic and an astounding 44% 40 years ago. This collapse in first-time buyer participation is unprecedented in modern American history. It's not just about higher prices or interest rates. It's about a fundamental shift in who can accumulate enough wealth to enter the housing market at all. The demographic shifts underlying these changes are even more dramatic than the headline numbers suggest. Census Bureau data shows that only 25% of American households now have children, plummeting from nearly 50% in the 60s. The percentage of married couples has plunged from 75% to just 47% of households. These aren't just statistics, they represent a seismic shift in American society and housing needs. But here's where our story becomes a tale of two markets, and it's crucial for understanding where the opportunities lie in 2025. The regional disparities in the housing market have never been more pronounced, and they're creating both winners and losers in ways that few people understand. The regional dynamics of today's housing market tell a fascinating story about how different parts of America are experiencing entirely different realities. Picture this: in the entire Northeast region of the United States, that's states like New York, Pennsylvania, Connecticut, Massachusetts, New Hampshire, Maine, and New Jersey combined, there are just 85,000 homes for sale. Meanwhile, Florida and Texas combined have 261,000 listings, the highest level in 8 years and more than 3 times the Northeast's inventory. What makes this contrast particularly striking is that before the pandemic, these regions had almost identical inventory levels. They moved in lockstep for years with similar seasonal patterns in response to market conditions. But something dramatic happened after early 2022. These markets completely diverged, creating what economists are calling the Great Housing Market Bifurcation. Let's break down why this happened. The Sunbelt states like Florida and Texas experienced a perfect storm of factors. First, they saw massive population inflows during the pandemic as remote workers fled expensive coastal cities. This triggered a building boom. Builders in Texas and Florida ramped up construction to historic levels. At the same time, investors and speculators poured into these markets, driving prices to unsustainable levels. By 2024, prices in many Sunbelt markets were more than 40% above their pre-pandemic levels. Meanwhile, the Northeast followed a completely different pattern. These states have strict zoning laws and limited land for new construction. When the pandemic hit, construction actually slowed due to stricter lockdowns and regulatory barriers. Even as demand surged, supply couldn't keep up. The Northeast also has an older housing stock, with fewer new homes being built each year compared to the Sunbelt. This divergence has created a pressure cooker situation in the Northeast, where prices continue to rise despite the national crisis. In markets like Boston and New York, we're seeing bidding wars even with mortgage rates above 7%. The median home in Boston now takes just 12 days to sell, compared to 45 days in Orlando or 52 days in Austin. The implications for buyers and investors are profound. In the Northeast, the severe inventory shortage is creating what we call a forced appreciation environment. Prices are rising simply because there isn't enough supply, regardless of what's happening with demand. Meanwhile, in the Sun Belt, we're seeing the first signs of what could become a significant price correction as inventory builds and demand weakens. Let's look at where prices are actually falling, because this pattern tells us something important about market vulnerability. Cape Coral, Florida has seen values drop by 5.6% year over year, while nearby Northport, Sarasota isn't far behind with a 5.3% decline. Naples has experienced a 3.6% drop. Austin is down 3.3%, New Orleans has fallen 2.2%, and San Antonio has declined 2.1%. These price drops aren't random. They're concentrated in areas that saw massive price appreciation during the pandemic and attracted significant investor activity. The correction we're seeing now is a direct result of that speculative excess unwinding. Please take 2 seconds to help us out and hit the like and subscribe if you find the video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. The luxury market tells an entirely different story. While overall sales have collapsed, transactions for homes over $1 million are up 35% year over year. This divergence between the high and low ends of the market is the widest we've ever seen. It's creating a bifurcation market where luxury properties continue to appreciate while entry-level housing stagnates or declines. This isn't just about rich versus poor. It's about a fundamental restructuring of who can participate in different segments of the housing market. Now let's talk about valuation, because these numbers should keep everyone up at night. Homes are currently 27% overvalued compared to long-term incomes, 21% overvalued compared to long-term rents, and over 50% overvalued compared to long-term inflation levels. These numbers represent the largest deviation from fundamental values we've seen in modern history, even exceeding the 2008 bubble in many metrics. What makes this situation particularly precarious is the unemployment rate, which remains at 4.1%. This low unemployment has prevented the kind of forced selling that characterized the 2008 crash, but it's also masking deeper structural problems in the housing market. The federal government has managed to delay a potential recession through massive deficit spending, currently running at $2 trillion, and various policy interventions. They've effectively kicked the can down the road, but at what cost? The immigration factor adds another layer of complexity to this story. Over the last 3 years, approximately 8 million people have entered the country, creating additional housing demand even as native population growth has slowed. This demographic shift is putting pressure on housing markets in unexpected ways, particularly in gateway cities and emerging immigrant destinations. For investors, this crisis presents unique opportunities, but only if you understand where to look. The key is recognizing that real estate has become more local than ever. Supply-constrained markets in the Northeast continue to appreciate even as the Sun Belt experiences price corrections. The luxury market remains robust while entry-level housing struggles. Success in this market requires understanding these divergences and positioning accordingly. The winners in 2025's housing market won't be those waiting for a return to normal, because normal isn't coming back. They'll be those who understand and adapt to a fundamentally changed market. This means focusing on supply-constrained areas, particularly in the Northeast. It means targeting properties that appeal to wealthy, older buyers who are still active in the market. And it means watching inventory levels closely. They're the leading indicator of where prices are headed. For first-time buyers, the story is more complex, but not entirely hopeless. While the national market remains challenging, opportunities are emerging in areas experiencing price corrections. The key is understanding local market dynamics and being patient. Some markets, particularly in the Sun Belt, are seeing inventory build and prices soften, creating potential entry points for prepared buyers. What makes 2025 potentially more concerning than 2008 is that we're not just dealing with a financial crisis. We're facing a structural crisis in housing affordability and demographic change. In 2008, once the financial system stabilized, there was a clear path to recovery. Today, the challenges are more fundamental, rooted in an aging population, declining household formation, growing wealth inequality, and structural affordability challenges. The political dimension adds another layer of uncertainty. With a new administration taking office, changes in policy could significantly impact the housing market. Potential shifts in immigration policy, tax treatment of real estate, and federal spending could all affect market dynamics in ways that are difficult to predict. Now, let us share something crucial for those of you looking to buy a home in this challenging market. Understanding these trends is important, but knowing how to prepare yourself for a purchase in this environment is even more critical. We're going to walk you through exactly what you need to do to position yourself for success in 2025's housing market. First, you need to understand that preparation for buying a home in 2025 starts long before you begin looking at properties. The most successful home buyers we're seeing right now are taking a comprehensive approach that begins 12 to 18 months before their planned purchase. Here's why this timeline matters. In a market where the median home buyer is 56 years old with substantial assets, you need to be extraordinarily well prepared to compete. Let's start with your financial foundation. In today's market, you need more than just a down payment. You need what we call a financial fortress. This means having not just your down payment saved, but also a separate emergency fund covering 6 to 12 months of your expected mortgage payments. With home prices 27% overvalued compared to long-term incomes, this buffer is no longer optional. It's essential. Beyond your savings, you need to focus on what we call mortgage readiness. This means more than just having a good credit score. You need to understand that lenders in 2025 are scrutinizing debt-to-income ratios more carefully than ever. We're seeing successful buyers keeping their total monthly debt payments, including their future mortgage, under 36% of their gross monthly income. This is more conservative than the 43% many lenders allow, but it gives you breathing room in a market where being house rich but cash poor can be dangerous. Here's something most real estate agents won't tell you. You need to become an expert in your target market long before you're ready to buy. We're seeing successful buyers tracking inventory levels, days on market, and price trends in their target neighborhoods for at least 6 months before making offers. Investors are using tools like foreclosure.com to be first to know when foreclosures hit their target markets by signing up for free alerts on foreclosure.com to catch investment opportunities the moment they arise. We've included the link in the description below. One strategy that's proving particularly effective in 2025 is what we call the two-market approach. Remember how we talked about the massive regional differences between markets? Smart buyers are researching both their primary target market and a backup market with better affordability metrics. We're seeing buyers who were priced out of the Northeast finding success by shifting their search to Sunbelt markets where inventory is building and prices are softening. You also need to understand that the traditional spring buying season may no longer be your best opportunity. With inventory levels varying dramatically by region, timing your purchase based on local market conditions is crucial. In the Northeast, where inventory is severely constrained, winter months often see less competition. In the Sun Belt, where inventory is building, you might find more negotiating power during peak listing seasons when sellers are competing for fewer buyers. Another critical preparation step is understanding the full cost of homeownership in 2025. Property taxes in many areas have increased dramatically as municipalities deal with budget pressures. Insurance costs, particularly in coastal areas, have seen double-digit increases. Smart buyers are requesting utility bills and insurance quotes before making offers, understanding that the monthly payment is just part of the total cost of ownership. Here's an insider tip that's proving invaluable in 2025. Build relationships with local lenders before you need them. With mortgage rates above 7%, having a lender who understands your financial situation and can move quickly when opportunities arise is crucial. The most successful buyers we're seeing have pre-approvals from multiple lenders and understand exactly how different down payment amounts and loan programs affect their buying power. But perhaps the most important preparation step is psychological. You need to understand that buying a home in 2025 requires patience and discipline. The days of making an emotional decision and having appreciation bail you out are over. Successful buyers are treating their home purchases like a business decision, using data to inform their choices, and being willing to walk away when the numbers don't make sense. Remember this: every crisis creates opportunity for those who understand what's really happening and are properly prepared to act. The key is to stop fighting the last war. 2025 isn't 2008. It's something entirely new, and it requires a new playbook for success. The winners in this market will be those who understand the structural changes taking place, position themselves accordingly, and prepare themselves thoroughly for what might be the biggest financial decision of their lives. If you want to stay ahead of this historic housing crisis, hit subscribe and that notification bell, and let us know what you're seeing in your local market. And watch this one as well.